All right, let's get right into it. Today, in this explainer, we're unpacking what is, without a doubt, the single most monumental global market event of 2026. After a pretty subdued couple of years of valuation resets across the board, the global capital markets are staring down a massive structural reconfiguration. I mean, we are literally about to witness an unprecedented wave of wealth crashing into the public equity sphere. And to really grasp the sheer scale of what's coming our way, we need to dive directly into the data.
First things first, let's lock down the terminology we're going to be using today. You've all heard of unicorns, right? Startups valued over $1 billion? Well, meet the hectocorn. A hectocorn is a private entity with a valuation exceeding $100 billion. We are looking at an incredibly rare breed of company here. Companies that have managed to scale to the size of an actual sovereign GDP, all while remaining entirely in private hands. It completely blurs the line between private and public market leadership.
And that brings us to this absolutely staggering number, $4 trillion. Just to put that into perspective, this represents the combined estimated public valuation of just 3 entities: SpaceX, OpenAI, and Anthropic. This single cluster of public debuts signals a historic, massive shift in global asset allocation. We're looking at a bull case scenario here that could see total US IPO proceeds hit an all-time record. It's going to completely eclipse anything we've ever seen before.
All right, Section 1, the Hectocorn Super-Cycle.
So, zooming out to the macro view for a second, we really need to understand the mechanics here. How does the arrival of these 3 titans fundamentally alter index composition and passive investment flows? Well, the absolute crucial point is the liquidity siphon effect. The sheer scale of fundraising required for these 3 companies is estimated to exceed $240 billion collectively. That is literally more than the total amount raised in the entire US IPO market during 2025. So what does this actually mean in practice? It forces asset managers into a ruthless zero-sum reallocation. Institutional investors are likely going to have to sell off highly profitable established tech holdings. Think your NVIDIAs, your Teslas, your Microsofts. Even your standard 401k is going to feel this shift. And why? Just to free up the cash they need to buy into these massive new offerings.
Moving on to Section 2, SpaceX's trillion-dollar orbit. Okay, let's set the baseline for SpaceX. They are targeting an eye-watering $1.75 trillion valuation for their planned June debut, which is internally codenamed Project Apex. With an estimated fundraising scale of over $75 billion, SpaceX is poised to become one of the 6 largest companies in the US by market capitalization, basically overnight. It's going to immediately disrupt the indices and instantly become one of the top 4 industrials in the world.
Now, here's where it gets really interesting. Look at the underlying economics. Out of a projected $20 billion in revenue for 2026, Starlink alone accounts for $15.5 billion. Starlink isn't just some side project anymore. It is operating with a massive 55% margin. And how are they doing that? Because SpaceX controls over 60% of the global orbital launch volume. They internalize their own launch costs using those reusable Falcon 9 rockets, which reduces the cost of access to low Earth orbit by about 97% compared to historical NASA averages. Competitors simply can't touch these margins.
And you literally can't talk about SpaceX without factoring in that massive February 2026 all-stock merger with xAI, which consolidated Elon Musk's AI assets directly onto the SpaceX balance sheet. This merger revealed an absolutely brilliant space data strategy. You know how terrestrial AI data centers are totally bogged down by intense land and cooling constraints? Well, SpaceX plans to bypass that entirely. They want to use their fully reusable Starship rockets to deploy massive, solar-powered server farms directly into low Earth orbit. It's an infrastructure play on a planetary scale. Honestly, the ambition there is just staggering.
Which brings us to Section 3, OpenAI's capital paradox.
So shifting gears to OpenAI, their numbers are just wild. We're looking at a company that reached an $852 billion post-money valuation following that historic $122 billion funding round. They're targeting up to a $1 trillion public valuation. But here's the catch. Their IPO window, which was originally targeted for late 2026, might actually get pushed to 2027. And the reason comes down to their incredible capital demands. Public market investors are simply demanding more quarters of clean execution before they jump in.
Take a look at this number. $1.15 trillion. That's not their valuation, no. That is OpenAI's long-term infrastructure obligation for compute capacity in data centers. It perfectly illustrates the harsh financial reality of frontier intelligence. Look, in 2025, OpenAI blew past $25 billion in annualized revenue, which is phenomenal, right? But to generate $13.1 billion of recognized revenue that year, they had to spend approximately $22 billion. That gave them a net loss of $9 billion.
They're basically spending about $1.69 for every dollar they earn. It really highlights the immense capital intensity of what they're doing.
Now, to be completely objective here, we have to look at the governance headwinds complicating this. This is a critical investor consideration. The U.S. House Oversight Committee, along with several state attorneys general, are currently probing CEO Sam Altman's personal investment portfolio for potential conflicts of interest. The focal point here is his $1.65 billion stake in the nuclear fusion startup Helion Energy, which, by the way, received a massive investment from OpenAI alongside his ties to Stoke Space. And what makes this really unusual for external auditors is that Altman holds no direct equity in OpenAI itself. He receives only a modest salary. So as you can imagine, that significantly complicates how auditors assess corporate stewardship.
Let's pivot to our third titan. Section 4, Anthropic's Enterprise Moat. Okay, looking at Anthropic's baseline, they've got their eyes set on an October 2026 listing. They are actively in the middle of negotiating a Series H round of up to $50 billion to bridge their computing power gap, and they're driving toward a $900 billion to $1 trillion target listing valuation. But what's really incredible here is their revenue growth. It's a total hockey stick curve. By May 2026, their annualized revenue surged past $44 billion. They actually surpassed OpenAI while deploying just a fraction of the capital.
And this comparison right here? This perfectly hits the nail on the head regarding the strategic divide between these two AI rivals. While OpenAI has this split focus, trying to defend ChatGPT's dominance with regular consumers while also trying to capture corporate services, Anthropic just went all in on a highly disciplined enterprise pure play. Over 80% of Anthropic's revenue comes straight from corporate clients, and that laser-focused strategy resonated so strongly with the market that it caused a literal valuation inversion on secondary markets like Forge Global. We actually saw Anthropic start trading at an implied valuation higher than OpenAI. So you might be wondering, how exactly did Anthropic lock down all these massive enterprise clients? Well, the secret sauce is Project Glasswing. Anthropic has successfully taken AI safety and turned it into a highly lucrative commercial asset. By using their Claude Mythos model, they provide select organizations with autonomous defensive cybersecurity. This thing can find software vulnerabilities across hardware and software at a scale that was completely impossible for human teams to match. And because major partners like AWS, Microsoft, and CrowdStrike are integrating this to hunt down every exploitable vulnerability that matters, it creates a massive competitive moat for Anthropic.
Section 5, Structural Market Shockwaves.
All right, pulling back out to the macro level again, the sheer scale of all this triggers something really unique thanks to the NASDAQ fast entry rule. Now, traditionally, a new IPO had to sit through a 3-month seasoning period before it could join the major indices. But under the new rules, if a company's large enough to rank in the top 40 of the NASDAQ 100 straight out of the gate, it bypasses that completely. So literally just 15 trading days after these megacaps debut, massive passive index funds and ETFs, like the $430 billion QQQ Trust, will be legally mandated to buy these stocks. This incredibly condensed window is expected to spark huge market volatility and likely a massive wealth transfer to fast money professionals who front-run those ETFs.
We also can't ignore the objective ESG headwinds here, which institutional investors are watching very closely. This includes specific emissions data cited in a federal lawsuit filed by the NAACP against xAI regarding its Colossus II data center down in Mississippi. The lawsuit alleges that they installed gas-fired turbines without the required permits, which reportedly produces thousands of tons of nitrogen oxides and carbon monoxide. And alongside that, you have organized protests happening at SpaceX's Texas Starbase over environmental and safety risks from rocket launches. These aren't just footnotes, these are critical factors that state pension funds and institutional models have to account for prior to any IPO.
Plus, because these listings are literally so gigantic, they're creating a massive global concentration risk, which analysts call the U.S. drift. Asset owners who use global reference indices, like the MSCI ACW, are going to see their U.S. concentration spike significantly, drifting from 61.75% to nearly 63%. This physically forces worldwide portfolios to become even more heavily weighted in the United States, specifically in the application layer of technology. It's demanding a geographic reallocation away from other developed markets entirely. So, to quickly summarize the risks we're looking at during this crowded IPO window,
First, you've got the zero-sum liquidity risk, where $240 billion gets siphoned away from existing tech stocks. Second, the fast entry trample effect, which creates these artificial price cliffs because of the forced ETF buying we talked about. Third is monetary policy. Sticky inflation could easily close this narrow IPO window before these capital-hungry giants even secure their funding. And finally, governance and regulatory drag, where ongoing investigations and lawsuits are going to demand much higher risk premiums.
Which leaves us with a huge question to wrap up this explainer. As SpaceX, OpenAI, and Anthropic hit the public market in 2026, are we witnessing the end of the private age of technology? I mean, this historic $4 trillion super-cycle forces a reevaluation of absolutely every business model in the industry. It opens up the frontier of space infrastructure and artificial general intelligence to the everyday investor, sure, but it also asks us to navigate a level of market volatility we have literally never seen before. It is the most important moment in modern market history. Keep learning and keep analyzing the data.